Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just jump right into it. We're looking at the very complex situation around EVgo Inc. The stock's trading, around $3.06 a share right now?
Which puts its market cap at, just under $1 billion, call it $942 million. But the strange part is this huge disconnect with what analysts are saying.
Exactly. You have these bullish institutional targets. I mean, 590, even 750 a share. That implies 150% upside. And yet you have this enormous bearish position staring you in the face.
An enormous one. Short interest is over 25% of the public float. That's something like 32 million shares shorted. So that's the real debate here, right?
Right. Is the company just fundamentally mispriced? A victim of, some short-term sentiment and these technical overhangs? Or is that huge short position actually justified by some serious fundamental flaws? I'm going to argue that it's the former. EVgo is strategically positioned, it's undervalued, and frankly, it's poised for a massive short squeeze.
And I'm going to take the other side. I think that bearish sentiment is, it's calculated. It's robust. I think this company is a capital-intensive execution play, and it's burdened by structural problems that right now outweigh any of the strategic talk. That short interest isn't just noise. It's a reflection of quantifiable risk.
Well, my whole thesis really centers on the idea that the company's risk profile has fundamentally changed. The current valuation, to me, is just irrelevant to where it's headed long term. EVgo is past that speculative, land grab phase. And this pivot is largely because of the CEO, Badar Khan. I mean, his background at National Grid US, he's bringing a utility-like infrastructure model to the company. It should be valued like an annuity, not on its current cash burn. And the strongest evidence for this, you have to look at the closure of that $1.25 billion loan guarantee from the DOE back in December of 24. That is a genuine capital fortress, right? It totally insulates EVgo from the high cost of commercial debt that's basically crippled its competitors. Management isn't just chasing stall counts anymore. They're focused on operational scaling, on throughput JW sold. This owner-operator model, it justifies the higher price-to-sales multiple, 3.67x, especially when you compare it to just hardware sellers like ChargePoint.
See, I'm sorry, I just don't buy that the whole capital fortress story is as clean as you're making it sound. It kind of overlooks the systemic issues here and the sheer speed of their cash consumption. The bear case is built on three, primary quantifiable risks. And first, we have to admit that at its core, EVgo is still a cash incinerator. In the 12 months leading into 26, the company burned through about $102 million in operating cash.
Right.
Think about that. Every quarter, they're burning roughly 25% of the capital they raised in their SPAC merger. That kind of financial pressure year after year, it proves that a strategic narrative isn't enough when you're just hemorrhaging cash. And second, the technical overhang from their majority shareholder, LS Power, it's a huge, persistent cap on the stock. Their sale of 23 million shares at $5 back in December, where EVgo got zero proceeds, by the way, that just signals this constant threat of a supply shock that's going to kill any rally.
You raise fair points on the cash burn, but let's actually use that to transition to our first real point of contention, that DOE loan facility. I see that $1.25 billion as the single defining strategic differentiator in this market. This isn't just money, it's low-cost, government-backed financing that they secured when commercial credit is still, punitive. Think about the competition. In 24 and 25, everyone else was forced to retrench, to conserve cash, to stop building. But EVgo, because of this loan, effectively gets to opt out of that credit crunch. It gives them this unassailable runway to get the skill they need for profitability, while their competitors are just starving for capital. It's an interest rate arbitrage that directly translates to market share. The $3 stock price just doesn't reflect that at all.
That's an interesting way to frame it, but if it really is a capital fortress, why isn't the stock trading closer to those $7 targets right now? Is it possible the market is telling us something? That maybe the covenants on that loan are already too aggressive? See, while the capital is low cost, it is absolutely not risk-free. It's a double-edged sword. This loan has extremely aggressive deployment targets monitored by the Department of Energy. it contains these strict material adverse effect covenants. So if EVgo fails to hit those milestones, maybe because of supply chain issues, permitting delays, whatever, it could trigger a default. And a default wouldn't just freeze the funding. It would put the entire balance sheet at catastrophic risk, especially with that $102 million annual burn rate you mentioned. So that DOE loan, it's the ultimate binary catalyst. Perfect execution leads to dominance, sure, but any significant stumble leads to absolute disaster. And that disaster scenario is only amplified by the market mechanics, which brings us to our second point of contention, the technical overhang. You mentioned LS Power, but we need to really define how that caps the stock. LS Power holds roughly 66% of the voting power through their Class B shares. When a sophisticated majority owner sells a huge block of stock, 23 million shares at $5, they are setting a very clear psychological anchor for the market.
Okay, so investors know that any rally up to or past that $5 mark is probably going to be met with another big sale from LS Power. It's their job to return capital to their partners. It effectively makes the stock dead money until that overhang is cleared, and there's no sign of that happening soon.
I see why you'd emphasize the supply dynamic, but I think you're fundamentally miscalculating the demand side of the equation. That's where the real potential is. You have to look at the extreme technical setup here for a short squeeze. Yes, the overhang exists, but the short interest itself, 25.38% of the float, is just massive. And critically, you're looking at a 13.25 days to cover ratio.
Which is very high.
It's incredibly high. Anything over 10 indicates there's extremely limited liquidity for all those shorts to actually get out of their positions. It creates a liquidity vacuum. So if any positive news hits, say they confirm that Q4 25 EBITDA guidance, or they get their first successful drawdown of the DOE funds, the scramble for shares would be immense. The short position is a powder keg. And while $5 is a psychological anchor, a true short covering panic doesn't care about that stuff. It creates a parabolic move that can blow right past that selling point. Plus, you have the high off-exchange short volume, the rising cost to borrow. The pressure is just building on the shorts every single day. But let's bring it back to the fundamentals. That execution risk you mentioned with the DOE loan, well, that capital is only worth it if the underlying business model is actually viable. And this is a third disagreement. Is this owner-operator premium justified, or will it just get crushed by commoditization? I would defend that 3.67x price-to-sales multiple by focusing on the infrastructure analogy. This isn't like selling software. EVgo owns the asset for decades. And institutional investors, I think rightly, see this as an infrastructure annuity that yields predictable returns over the long haul. Success is all about hitting operational leverage by crossing that critical utilization threshold, somewhere around 10 to 15%. Once a stall is used more than that, the fixed costs are covered and the gross margin just expands rapidly. That's what justifies the valuation.
I'm sorry, I just don't see how that annuity structure survives the reality of the market right now. We can talk about utilization thresholds all day, but we have to face the $1.5 trillion gorilla in the room, which is the Tesla hegemony. With the NACS standard now adopted by GM, Ford, everyone, all of their customers now get a seamless charging experience on the supercharger network. That immediately guts the competitive advantage of a third-party app, like EVgo's. Tesla makes its own chargers cheaper, it controls the entire experience, and it operates at a scale EVgo can only dream of. That competition is going to compress EVgo's margins to unsustainable levels. You argue for a premium based on a utility model, but utilities have regulated geographic monopolies. EVgo has no protection. So why would any rational consumer choose the EVgo network over the more reliable, more integrated, and probably cheaper supercharger network? The market is pricing in the reality that the utility-like return you're hoping for gets eroded long before they ever hit profitability. And let's turn to management signals, because that often tells you what insiders really think. If the fundamentals are so great and the DOE loan is such a fortress, why do we see these problematic optics around insider activity?
Specifically, CEO Badar Khan sold nearly $600,000 worth of stock in November of 25, while the stock was near its historic lows. Now, you could say it was a routine 10b5 plan for diversification, totally legal.
It almost certainly was.
Sure, But sophisticated investors look at the optics. An executive who truly believed his stock was about to rally 90% from $3 to $6 would have probably paused that automated selling plan. The fact that it executed tells me there's a lack of urgency about the near-term upside. It suggests that even management thinks the technical cap and the execution risks are real enough to warrant selling at these prices.
That's a compelling point, but I think it's a distraction from the main strategic shift. Focusing on a small, pre-scheduled sale, it misinterprets what kind of leadership the company needs right now. Khan's utility pedigree, his focus on profitability, that is the real signal. He ran National Grid US. He's focused on systematic deployment, on throughput, on utilization. The market should reward the tangible execution against that adjusted EBITDA break-even target for late 25, not get hung up on cosmetic insider buys or sells. I mean, to suggest a small sale at $3 should overshadow a $1.25 billion loan and a fundamental shift in strategy, it just doesn't square with the institutional price targets we see.
So, to summarize my view, while the DOE alone gives them a necessary runway, the equity itself remains exposed to just extreme volatility and binary risk. The LS Power overhang creates a ceiling, while the massive execution risk tied to the DOE covenants creates a floor that is much weaker than they'll admit. You combine that with the $102 million annual burn and the threat from Tesla, and this stock is really just a leveraged bet on a number 2 player surviving in a brutal market. The low valuation is justified because the odds of flawless execution are slim, and the equity is just disproportionately exposed to any bad news.
And my conclusion is that the stock is completely disconnected from its actual strategic position. The capital fortress is real. It gives them a unique window to build network density that no competitor can afford to match right now. If the company confirms that EBITDA break-even milestone in Q4 25 and successfully starts drawing down those DOE funds, the entire short thesis, the bankruptcy argument, is shattered. And when that catalyst combines with the extreme technical setup, that 25% short interest and the 13-plus days to cover, that news will fuel a massive, violent squeeze, driving the stock right up toward those $6 and $7 institutional targets. The risk-reward, to me, is heavily skewed to the upside.
So we both agree, then, that the path for EVgo it's inherently binary. It's defined by execution against some really substantial headwinds.
Precisely. And for listeners trying to make sense of this, the future is really going to be determined by 3 specific things we talked about today. The market is waiting on these signals.
First, you have to monitor the utilization rates and throughput growth in their earnings reports. That is the real heartbeat of the owner-operator model. If utilization doesn't get above that 10 to 15% threshold, and soon, the cash burn just continues.
Second, track the short interest trends. Specifically, watch that days to cover ratio. If you see that number start to fall below 10, it suggests the shorts are finding a way out and the potential for a catastrophic squeeze is fading.
And finally, you have to watch for any sign of open market insider buying by CEO Badar Khan himself. That's the single most powerful non-operational signal he could send to reverse sentiment and really ignite a move toward those higher price targets. It would signal his confidence in this distressed valuation. The battle between strategy and market mechanics, it continues.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.